Good morning, everybody. Today I'm going to talk to you guys about some rental property goodness, okay? I am going to do a little bit of math just because numbers is kind of the game of the rental property world, and I'm going to try not to be too excited about this cool stuff this morning, but I won't worry too much about that. Okay, what I want to touch on, there are so many awesome things about rental property. The one I'm going to try to focus on today is depreciation, okay? You might be thinking, depreciate? Really? Like, if your car depreciates in value, why would you be excited about that? It's worth less, right? No. Okay, so this really mainly applies to investment property, okay? You have a single family house, duplex, apartment building, whatever, and you're renting it out, okay? So this is some of the cool stuff that you get to do with taxes and income and all that type of stuff, all right? So it actually depreciates, okay? You look in the IRS code and it says, okay, I don't know, it's 27 and a half years, okay? So like, you know, a giant skyscraper or a single family house, it's rented out, so we're gonna depreciate it according to tax code, 27 and a half years. Obviously, I'm not a tax professional. This is just what I've heard, and this is what we go by, 27 and a half years, okay? So 27 and a half years. What that means is, hold on a second. We're just gonna keep going, okay? Okay, what that means is you have, let's say, $100,000 property, okay? So you have $100,000, that's the value of the property, that's what it's assessed at in any way, okay? Well, you can't depreciate land, because you could blow up land and it'd still be there, right? I mean, so let's take off the land. Let's say $100,000 property, let's assume that 20,000 of it, just for argument's sake, is the land portion. So 80% is the improvements, which is the house, the buildings and such, so $80,000. That $80,000 we could depreciate, so 80,000, okay, divided by 27.5, okay, and that is $2,900 a year. So $2,900 a year we get to say is a loss, okay? I mean, granted, there is some of the back end stuff when you sell, okay, recapturing and whatnot. We'll get into some of those advanced strategies later on, okay? But for right now, our yearly, our day-to-day, okay, $2,900, we get to say we lost money on it, all right? That's even if we made money. So let's say we brought in, it cost us $1,000 a month to keep this property, okay? Well, we rent it out for $1,200, because why would we rent it out for $1,000 or less? That wouldn't even be worth our time, right? You know, you'd be like in a non-profit or something like that. Don't hate me for that comment. I don't really realize what I just said, all right? Well, the spread between the 1,000 and the 1,200, if you're following me in that example, you make cash flow $200 a month. Well, look at this. 2,900 divided by 200, 2,900 divided by 12 is $240 a month. So on your tax statement, it actually looks like you lost $240. So negative $240. You lost that a month. But in reality, because it cost you $1,000 and you're taking in $1,200, you actually got to take $200 real money, grocery money. You gave it to your kids for allowance. You went and bought groceries with it. You stuck it away so you can, you know, repair something down the road or whatnot, okay? Or even above and beyond that. So $200 cash flow, real money. But you got to say you actually get credit as if you lost money, all right? Which, that's awesome. How cool is that? Here's just the opposite of depreciation here. So depreciation, I don't think you guys can say that. My wife says I write at two weird angles here. You're depreciating it to lose the negative 240. At the same time, in almost all the markets and whatnot, depending upon cycles, not guaranteed, but for a long time it kind of has, it'll actually go up in value, you know, because it's property value. They're not making more of it, land, whatnot. So let's say the $100,000 property actually went up. Be super conservative here. Just count, not even counting it, 3%. Okay, it's going to at least keep up with inflation. Well, it's 3%, not of the couple thousand that you put down, but 3% of the $100,000. All right, that's $3,000. Look at this jam, guys. It went up in value $3,000. You got to put $200 in your pocket, and at the same time, you get to write off $240 a month. How cool is that? I mean, granted, this is an annual, so that's another, let's say, $240 a month in value, but you're depreciating it. This guy is super cool. Obviously, these are all generic numbers. There's not a specific property I'm talking about or thinking about it. Not guaranteeing anything here. This is just an example, but hopefully I scratched somebody's itch here. This is super cool. So, anyways, I think everybody should own, a house at some point, and later on, try to get into the rental game. Let me know if you want to grab a coffee and chat more about this stuff, because if you can't tell, I get a little bit excited about it. So, you guys have a good day.